In this episode today, we have Harry Dent, and Harry is calling right now for a large correction, or dare I say, a crash in the economy. We're at a very interesting situation where there's a lot of people that are still without jobs, lost their business, holding on to their house just by the sheer fact that you're not allowed to foreclose. So we're in an interesting time, and we're going to get Harry's assessment on what he believes is happening and looking at the markets. Now, before we do, just want to encourage everyone to hit the like button on the right side, the left side, send this out to more people to spread the message. And just last but not least, a shout out to our channel sponsor, which is Vizsla Silver. So thank you, Vizsla Silver, for being our mining stock sponsor. And it's good to see you, Harry.
Yeah, good to be here, Jake.
All right, so you got to tell me, what's your assessment right now, right? We've got so many people behind on mortgage, behind on rent. You know, you're starting to see the stock markets have another big down day. The stimulus still hasn't come through. There's a lot of theories. Some people say inflation, some people say deflation. But give us your assessment.
Well, first of all, my biggest entertainment is the stock market. I call it the market's on crack. How could you have this big a shock to the economy, this much desperate stimulus, which has only had minor impact to bring us near where we were? And the markets are acting like we're going to be better than ever. I'm like, how? With a lot of industries crippled for maybe years. Me as a speaker and traveling, that's been crippled already for over a year, a big piece of my income and stuff. So I think the markets are just totally out of kilter. And it is for a simple reason. We had the greatest boom in history, which I was one of the first people to identify in the 80s, that the baby boom generation was an outsized generation. And they were going to enter the workforce and grow up and spend money and raise families and buy houses and do all the stuff people do and cause the greatest boom in history. And even back then, I said it'll be over by the end of 2007. That's when the last baby boomer will peak, and then we'll start to see the baby bust slow down the economy, even though they're doing the same stuff. It's just fewer of them. And what's happened ever since then is the central banks realize, oh, we're going into like a big downturn, and oh, it's not coming out, and even with low interest rates. So they just decided to print tons of money. Well, we don't have anything else to do, so we'll just print trillions of dollars. They just wanted to get the economy to bounce at first, but what they found out was it's the only thing that worked. Lowering interest rates didn't work. Baby boomers, corporations, governments already up to their eyeballs in debt. And baby boomers had already peaked in spending. So they're not going to borrow more to spend more. So they just basically threw money in, and they realized, oh, when we do put a lot of money through quantitative easing, which is them buying financial assets, they're adding more dollars to the financial asset pool in the country and in the world, all central banks. So what are they doing? Are they really stimulating the economy? Well, no, only for the richer people who own most of those financial assets. And only a small percentage. No, they're just pushing up the biggest financial asset bubble in history. So that's all we have today. Why does the market get as big a shock as COVID, see massive deficits to fight it, which are only going to cost, and our debt's going up towards 40 trillion in the next few years, which another thing I've been predicting for the last 5 or 10 years, been doubling every 2 administrations back for a good while. The markets don't understand what's going on. All they know is the money printed ends up back in the markets, and it keeps going up. And frankly, Jake, it just goes up till it blows. There is no demographic trend to save us until the millennials start to take the reign from 2023, 24 forward. So a couple years out. There is no magic bullet. They're just pushing up financial assets. And now we have the biggest financial asset bubble in history, the last one of this magnitude. You got to go all the way back before I was born, 1929, okay? That was the biggest stock crash in U.S. history. It was also a big farm crash and things. There's a whole reason behind that, but every 90 years, we get these major bubbles. That's one of the cycles I study out of many. But this one came because the baby boom slowed the economy when they peaked, and because they couldn't find out anything to work. So they just kept printing more and more money. So the problem now is not just debt, global debt at $3 0.3 times global GDP, when normally it's maybe a 1.5, or financial assets, which are normally maybe 2 times GDP. The financial asset bubble, $525 trillion globally, is 6.5 times global GDP. And it's similar in the US, 6 times GDP in the US. That's the problem. This bubble has no connection to the mainstream economy, no connection to everyday consumers who are really, their incomes or spending are growing very slightly or none at all. And guess who's spending all the money? The top 10, 20% that own all these financial assets. 88% of stocks, for example, are owned by the top 10% of investors. So that's where it's going. That's who's spending. So we have rising income inequality. We have the greatest bubble in history. And I'm telling you, it can only do one thing. And people tell me, Harry, they won't let it. They won't let it. That's what they told me in Dubai. I was lecturing in Dubai for a big Tony Robbins Platinum Conference in late 2007, before the biggest real estate bubble of that day peaked. And I said, this thing's crashing, baby. It's a bubble. And people said, Harry, but the government won't let it. And I said, the fact that the government's pumping it up is the biggest problem. It crashed 50% the next year. A 50% crash for real estate is like a 90% crash in stocks, because it's leveraged and it doesn't go down as much as stocks. So I think we're getting ready to see the greatest bubble in history burst. Normally, the bubble would have peaked in late 2007, which it did initially. We go into the downturn. When that downturn started to look like a depression instead of a recession, which is what I was forecasting at the time, because of the end of the baby boom and the excessive debt and all this stuff and bubbles, the governments went wild. And they're just doing more and more. They printed as much money in the last year as they did in the 8 years of QE before that. They've just added way more fiscal stimulus. So just in the last year, $3.4 trillion in monetary stimulus on top of all they've done before. 5.4 if you count the new Biden deal at 1.9 trillion in the last year. In fiscal stimulus, that is 42% of our GDP that we're using to stimulate it just to keep it growing at 1.5%. Is this something wrong here? I can't get anybody to get it, Jay. It takes this much stimulus to keep an economy growing at 1.5 to 2%, the slowest in history, and the stock market's at the highest rates, like we're in the best economy ever. And everyday people have been sucking wind for over a decade, seeing almost no improvement in their spending income or standard of living. This bubble has to crash to get rid of the financial asset bubble, get rid of the debt bubble, write down a lot of debt, take burdens off of consumers and businesses, and free up the economy to grow again, especially when the millennials finally do drive their generational spending cycle, which I've been talking about for decades. Starts around 2023, 24, goes into 2036, 37. That'll be the next boom in the United States and globally. But we can't move into that boom, just like Japan in recent decades, until we clear the debt bubble, which has now become, to cure the debt bubble, we have a financial asset bubble that's twice as big. So think of that real quickly. I know I'm going long here. All of this is money. Debt is money created out of thin air, 10 to 1 to reserves. Financial asset bubbles bubble more and go up. Stocks, real estate, everything, bonds, when there's more money created in the economy. We got $525 trillion that's set to go poof and cut in maybe 40 to 50% historically. So if that happens, $200 to $250 trillion leaves the economy globally and doesn't come back. And that will cause a huge shakeout in debt, companies, economy, everything. It will cause a depression on its own. That's what I'm seeing. Unfortunately, we could have been over this by 2010 if they hadn't printed their way out of this and just let the economy do its thing, like we do when we get a common cold. We get rid of a lot of bad stuff and then get healthy or anything else, but they didn't. So unfortunately, and this just happens to be, these generational cycles are about every 40 years. This 90-year cycle is a double technology cycle where you've always seen the biggest bubbles. And this money printing just happened to play into that cycle. I was originally forecasting 2007 would be the peak. We'd have a deep downturn for about 12, 14 years and then come out of it a few years from now but the worst would come at the beginning. Because they printed their way out of it, we're going to get the worst at the end. The opposite of the Great Depression, where the 29 to 32 crash and the unemployment at 25% was the worst. And then the one at the end between 37 and 40 was just a deep recession. So
what makes you
deep depression in the next few years by my calculations? All you can do is get the hell out of the way because there's nowhere to run but the safest bonds and cash. And I'm telling you, even gold will go down in the early stages.
So then let me ask you, right? Because, what you say is, it's a lot of common sense, makes a lot of sense to me. But the response that, the argument back that someone would make to you, which, I'm sure you're familiar with, is they would say, look, I agree with what Harry's saying there in principle, but the reason that you won't have something other than just another flash crash is because they're going to go to straight MMT. They're going to start buying stock. So maybe you get a flash crash, but they just
ask yourself how that Japan's been doing that way longer than us. They started in 97. We started in late 2008. They've been doing it for decades. Japan, let me describe their economy. Real simple. One word, zero. Zero average growth.
Yeah, but why do you think that we won't just do the same thing?
We will.
Yeah.
But their market, the difference between us is their financial asset bubble burst. Their real estate crashed and their stock markets crashed before they came up with the concept of quantitative easing. We didn't. We've got to get this financial asset bubble out of the way. Now, Japan is not growing because they never deleveraged their debt. And secondly, their demographics are bad and just keep getting worse, okay? Our demographics are so-so. We're moving sideways as a country. So we don't have the demographics depth, but we have a much worse financial asset bubble now. We cannot grow with this bubble hanging over. How many millennials can afford a home in this real estate bubble? How many millennials, if you invest in a stock market that's already valued at 30, 40 times earnings, can possibly expect any model with no demographic downturn? Just valuations alone would say you're going to lose 2% a year for the next 12 years with no economic downturn, just because stocks are that overvalued. How do millennials have a chance to buy a house, have a decent standard of living, and to grow out of all the debt, including their student debt that they've accumulated? And, their parents were supposed to inherit money from their parents. Well, their parents, are going to lose it all and are in hock. So the common sense is you don't get something for nothing. And we've been living on something for nothing now for 12 years, a little over 12 years. Just printing more. And there is something called diminishing returns. That is an important universal concept. It takes more and more and more, particularly in addiction cases. I would say what we have in this economy, we are addicted to a financial drug called quantitative easing. It's like alcohol, it's like heroin, crack, coffee, whatever. It takes more and more to keep the high going up and more to keep from coming down until there's only one ending to addiction. Fall down, rehab, or die. That's the two endings. There is no, it gets better and better and somehow you come out of it if you keep taking more. No, you die or you go into rehab, or both. And that's what I see. Until we shake this excess out. Again, the debt bubble was already bad in 2007. Now it's maybe 30% worse. The financial asset bubble is way, way worse now. And that's the big limitation. All we have to do is go through a few difficult years, 29 to 32, okay? Even in the bubble, 2002, we shook out a lot of excesses in at least the markets, and then we're able to boom again. We cannot, believe me, you cannot grow out of this on this basis. You've got to deal with the real problem, restructure financial assets, which will only happen if you restructure debt, which will only happen if 19% of the zombie public companies, that's a giant percentage, by the way, of public companies. Imagine how many small businesses fall into that category, can't pay their debt service and barely alive. Until those companies fail and get out of the way and all those debts get restructured. You have to restructure debt. The Great Depression.
If they don't allow these things to happen.
Flying out of it.
But what if they don't, I agree with you, right? I mean, and I think most people would look, you're right. These are what need to happen to have a better economy or a better just society for my generation, and I've got a 6-month-old baby. But a lot of people say they're not going to let it happen. They're going to intentionally devalue the dollar.
Did Dubai let it happen? That's my answer. Time and time again. Does anybody let that? Nobody would choose to burst a bubble once you're in it, because they tried to just taper a little bit, Jake. Just taper a little bit in 2017, 18. Boom, repo crisis, banks out of money. And then they had to print more money than ever just to keep it going. It's like, if you stop drinking, what happens?
So what do you think would be a catalyst?
Sweat and shake and puke. It's not anything anybody would choose. It's something that you lose control of. They will not choose to let it happen. They're blowing up above. What I'm saying, and I'm saying it as definitively as will ever be said in history, you cannot blow this bubble up much farther. They've already done it. The bubble is going to blow despite whatever they print and do. And I think we're very close to that. And when the bubble blows, then the debt deleverages, then the zombie companies go under, then the jobs go, and then people stop spending and never believe something for nothing economics from the stupid ass Federal Reserve, which you question right away. Why do we need a Federal Reserve? We don't. We didn't have one for some of the best decades in history. We got one in 1913, and 20 years later, what do we get? The 29 bubble and the Great Depression. What does that tell you? They overstimulate the economy. They become the pusher to keep it going, because no politicians want to have a recession. You have to have recessions. Recessions clean out the debris. Here's the best example. I just read this out of a stunning article. Forest fires. Park rangers are way smarter than economists. Park rangers understood decades ago, and I remember being told this when I worked in Yosemite and Yellowstone National Parks. You let most fires burn because it clears out the underbrush and stuff. If you don't let them burn, the underbrush comes, and then when you finally get one, it's going to be a way bigger fire with way more tinder to set it off, and you won't be able to control it. That's what we've done. You have to have recessions to constantly clean out the failures. Free market capitalism is great because it rewards success and innovation and entrepreneurs, but it's also great because it allows failure. You have to let the bad concepts, I'm in the entrepreneurial realm and have been since I left Harvard Business School and Bain and Company. Okay, I've been in the entrepreneurial realm. 9 out of 10 real entrepreneurial companies that create something new and not just the local dry cleaners or a franchise, they go under. A lot of them have to try and compete, and 9 out of 10 go under to make way for the one that's going to succeed and become the Amazon or whatever in their industry. That's the way it works. If you don't allow success and failure, see, we have an economy that since late 2008 says we will not allow failure, and Japan's been doing it since 1997. And Japan should have been the shining example. This doesn't work. Yes, you don't go into a deep depression, but you never grow again. And I challenge somebody to look at the Japanese statistics. Forget the stock market right now that's just as high on crack as ours is and way overvaluing. And I'm telling you, Japan has even a worse demographic wave. I was the only guy in the world that called the Japan peak in 1989, knowing that their demographics had peaked ahead of the rest of the world because nobody looks at demographics, and they had the biggest bubble back then. Do you think the Japanese government let it peak and pull it down? No, they didn't let it peak. It just peaked. They overinvested, and the markets got overvalued, and the bubble just finally burst, and then it got the best of them.
So what do you think the catalyst for that is, right? When you say the bubble bursting, is it nothing? It just Mother Nature one morning, or is it people losing confidence in fiat currency? Is it people selling? What causes, this type of catalyst that you are predicting?
What causes an avalanche? One snowflake, one extra flake just hits and boom, it's sitting there with it's holding on the ground, and then just that one little thing, boom. That's what caused it. This is a bubble. I mean, Jake, I was not a bubble expert early on. I was demographics and cycles. I got into bubbles when we started having such extreme bubbles and started pumping them up more. I've studied bubbles up and down. They're like, in fact, I have a simple model. I can look at you blindfold me, well, not blindfold me, but you don't let me know what something is. Show me any chart of anything, any financial asset or probably anything, And I'll tell you if it's a bubble or not, because I'll measure it against the bubble standard. You know what that is? The male orgasm. Masters and Johnsons. The scientific study of the male orgasm traces out a bubble curve. It gets more exponential until, now get this. What causes the orgasm and for it to end? It gets so intense, it just can't go any longer. That's an orgasm. And then men are done. Women want to cuddle, women want to talk. Men have no interest at that point. They're dead because it took so much to create that cycle. So I can put that pattern on any market. You know, all the great booms, the 50s and 60s and 40s, none of those were bubbles, or very few, maybe the nifty 50s, some, you know. This whole, everything's in a bubble, and bubbles are not sustainable. You can't keep going up this exponentially without hitting a limit. That's all it is. You just hit a limit. I am not looking for the governments to do anything to prick this because they know better than anybody. They cannot. All they did was just pull back. First of all, they said we'd only need the stimulus for a year or two, then we'd be back to normal. Nope, forever. And then they finally, 8 years after they started stimulating endlessly, decided to just taper back ever so slightly, and boom, repo crisis. They had to print more than ever. You get off the drug, you're going to go into detox. Think of debt deleveraging as detox. That's what it is. Detox sucks. Nobody would choose it. Nobody chooses it unless they're down and out and have no other alternative. Nobody's going to choose this bubble burst. It's going to happen. All I tell people, and my indicators are saying we're getting very, very close, if not already there. Just get out of the way. You go for the last 5 or 10%, God bless your soul, because the next crash is going to be 40 to 50% in 2 to 3 months, and nobody's going to see it coming. I think we could see that by April. I mean, I think we could see the markets down 40 to 50% by April or May.
So what do you think it looks like on the other side of that? Obviously, you know, many would say that, you know, you get this type of correction, crash, whatever word you want to use. You have a, you know, as you said, you have a 40, 50% drop very quickly, a couple months. If that were to occur, is the response then met with an insane amount of walls of money and direct payments to people and print $1 zillion and then put it into all these stocks and the Fed starts buying it? What happens in a situation like that?
Well, I'm debating Jim Rickards, who is a very well, probably the best known gold bug and the most competent I've found.
He's been on my show a couple times, yeah.
I'm doing that on an Australia online event Wednesday night. GoCoGroup.com/den if you're interested in that. We're going to be debating just that.
Okay.
He agrees now, which many gold bugs don't, that the next stage is going to be deflationary. This bubble's got to burst, and that is always deflation because your money is disappearing. Remember the number I said earlier, out of 525, and that's as solid a number as you're going to find for all the financial assets in the world, okay? If that bursts, 2 to 250 trillion disappears. Do you think the central banks in the next couple years or even months can print money that fast without looking like the biggest idiots in the world or desperate? Or is it even possible? Does Janet Yellen and Powell look like they're that quick on the draw? That's smart? You know? I don't think so. So that's what I mean. The avalanche comes. Once the avalanche comes, all you can do is run or kind of create a bubble to breathe in. It's over. You can't stop an avalanche once it's begun. The problem is letting the avalanche build, and that's what they've done. So they're going to be victims of their own artificial something for nothing solutions to a real and proven over time problem that's happened all throughout history. The longer a boom goes along, the more complacent people get and the more governments stimulate. Nobody wants a recession. Nobody wants, you know, and then you get a bubble and then it bursts and then everybody wakes up. What it looks like on the other end, everything gets decimated and people immediately, did I make that clear enough? Immediately get real. How do you get a person real? Start a fire next door, okay? A crisis makes people real. In a crisis, you'll see everyday people become the biggest heroes when there's a crisis and all of a sudden the barn's on fire and the horses are threatened or there's a baby in there, and everyday people will run in there like a hero and save the baby or horse and run out and not even think about it. People get real. That's going to come from businesses failing, jobs failing. People, I mean, look at this COVID thing, just that shock. How many people now are working more efficiently from home than they did before, thinking, well, I can't, there won't be enough social and or my boss won't let me. Australia, I've been telling them for years, that's my biggest market per capita. I should do more online stuff. Oh no, Harry, it's gotta be live, mate. No, BS, we just proved it's not. We're doing better than ever at lower cost because we were forced to do something different. So when things fail, people wake up. When things keep cruising and, oh, we have another stock crash and another little recession. Oh, they print more money than ever. Oh, now it's okay. What do people do? Sit on their ass and keep doing the same old stuff. Markets on crack. People staying in jobs and things that are no longer viable in an economy that's not even real. Price earnings ratios are meaningless because you don't even have a real economy. We would have no earnings because we would have no GDP growth without $25 trillion of printed money globally in the last 9 or 10 years. We wouldn't even have any of that to even measure price to earnings against. So even the price earnings ratios are the second highest in all of history. Only the last tech bubble popped, which alone would tell anybody with any sense, I better get more conservative in my investments. But that's based on earnings. Those earnings were not funneled by monetary theory and quantitative easing. Those were just a great economy and people got too speculative. And yes, interest rates got a little low, but they were not pumping money into the economy like now. This is way worse. So you got to get out of. I'm just telling people. I'm telling you right now. 95% of people will think I'm a nut, and only 1% will listen to me. Well, if I can save that 1%, I've done my job. Because I'm telling you, from my view, and I've studied. If you see anybody study history more than me, I will kiss their ass in public. Okay, I will bend down and kiss their ass in public. Because you won't find somebody that studied economic history more than me. Not even professors. Okay. This is obvious and it is inevitable. It's just a matter of when the avalanche starts. What's that last little stimulus, that last little crisis that just takes it too far? And I got a chart saying higher highs, the next lower lows, 2100. I think if the stock market in the next so many months does go down to new lows one more time for the third time since the beginning of 2018, after this much stimulus and this much push and everything else, people are finally going to get, this isn't working. And then you look and you say, I'm real. Oh, we've had the slowest growth economy in history with stimulus that is 10 times anything ever for the longest period ever, and we're only growing at 1.65%, and the stock market somehow thinks that's hunky-dory. As soon as you wake up out of slumberland, it's like, oh crap, this is a bubble. And then it bursts, and then there's nothing you can get people to do to come back. They see it. And the other thing that happens, and I got an indicator right now in my March newsletter I'm about to put out, shows that basically investors, active investors, are now for the first time 100% in equities, 100% exposed to equities, and the most bearish ones, 20%, are 80% exposed. That's all the money in. There's nobody left to put in. There's only the smart money, the 1 or 2% of people that think like I do, that will start shorting this market on leverage and start to drive it down with no resistance, because there's nobody left to throw their money into greater fool theory. That's how bubbles burst. You reach that tipping point, which is hard to determine. You can just tell when that orgasm is near because it gets so exponential. Oh, actually, Jeremy Grantham, if you've ever heard of him, he's one of the granddaddies. He doesn't come out very often, okay? He's come out just in the recent months and said, with euphoria this high, we are within months of a major bubble peak, no longer years. He hasn't come out to now. He's thinking like you, and everybody asks me, well, Harry, why don't they just print more? Yes, they will, but there is a point when a guy like Jeremy Grantham comes out of hiding and says, this is it. I agree with him. I agree with almost nobody else.
So then let me ask you, so for someone listening, right, and they say, all right, so what do I do? So tell me the ways that you personally are preparing, or if, you were talking to one of your buddies and you said, here's what I'd be doing. I mean, are you just sitting in cash? What are you doing?
Okay, sitting in cash would be a good thing to do, because a lot of people will go to a debate like me and Rickards this week, and so he says, well, inflation and gold. And I say, no, deflation and treasury bonds. So, well, they both make sense, and we do both make sense. We both have a lot of data behind us. I just say I have more, because I can guarantee you most of the bubble crashes in history have been deflationary, not inflationary. That's slam dunk in my favor. But forget that. There's a good argument on both sides. I'm for the treasury bonds. You lock in even a low 30-year yield on a treasury bond, which the government will print money to pay if they have to, okay? We know if there's anything they'll still print for. Those bonds are not going to be defaulted on. Interest rates will go even lower in a deflationary spiral like they did in 2008. And that bond, I've already calculated in advance, if that 2.2% yield today on 30-year goes down to 0.4, 0.5%, and it could go to zero, but I'm looking at past crashes and calculating it more. That bond will go up 40% in value, yet you're sitting in the safest investment in the reserve currency, the best house in a bad neighborhood of the major currencies. And I'll argue that with anybody any day. You think Japan or Europe or China's in better shape than us? You are wrong. Demographically, debt, money printing, you name it. They're wrong. Money velocity, every measure I have. The US is not good, but it's the best house in a bad neighborhood. And currencies traded, they don't have an absolute value. They trade relative to each other. So I want to be in US dollars, especially if I'm overseas and not in the US, 30-year treasury bonds, AAA corporate bonds. Those are the only asset class that did well throughout the entire Great Depression. Stocks bubbled up, went down, bubbled back up again, crashed again. Real estate went down, stayed down. Commodities went down, stayed down. The only difference then, as I said before, we had the worst crisis at the beginning because we didn't have this quantitative easing shield against recessions. Nobody had invented that yet. They did start quantitative easing for the first time in late 32 to respond to how bad the depression was, but they didn't use it much after that. So we have the worst at the end this time. And here's another contrary thing that I'm predicting is going to happen. Nobody believes that they can go down now, and you don't either, and then for good reason. And everybody would think that because you've already seen them fight every downturn. When we do have this downturn in the next 2 to 3 years, max, people are going to be saying, oh my God, then economists are going to turn around after being, head in the sand. Oh, it's okay. And Warren Buffett, oh, it's okay. They're printing all this money. It's for the good of the economy, da, da, da. They're going to turn around and say, oh my God, we're in for a long depression. 1930 to 42, 1968 to 82, inflationary crash. They're going to be seeing, oh my God, now that we're in reality. Well, they don't understand. We're at the end of the baby boom down cycle. This bubble will take $2 to $250 trillion out of the economy so fast, people won't even see it coming. It'll be like COVID, bam. That was 2932. I think 60% of private debt disappeared. That's a weight off of people's back. Is it painful? Yes, it's painful. But it's a weight off the back, and it frees you up to grow again. And unlike Japan and some countries in Europe and China even, we have room to grow again because the millennial generation is substantial in the United States and Canada and in Northern Europe. And very strong in Australia and New Zealand. Certain Western countries like us are going to be able to grow again if we just get this bubble and debt burden off our back. It takes courage. And since the government officials, we all agree, are not going to do the right thing, absolutely not in 100 billion years going to do the right thing here. We just have to get out of the way, let the bubble crash, and reinvest. And okay, so I like treasury bonds. I'm talking to a guy today. Richard Hurst, I think his name was, with Hex. It's a new crypto thing. stable coins and things like that. And here he locks up coins. There are coins that are designed to be more stable and just generate interest. Well, that's a lot like a treasury bond, but it's in a new technology. I could see that being a good hedge. What I can tell you will not be, there are no stocks that will not go down, hardly, and most will go down. Conservative stocks go down 50, and aggressive stocks will go down 70, 80, 90, just like in any major crash like 29 to 32. Real estate has had a bigger bubble than last time. Last time the crash was 34%, I say, and very predictably, I think. 50% this time. Think how painful the last one was. But what does that do to real estate and affordability for the next generation? Oh, wow. And mortgage rates are going to go even lower as interest rates go down. So the downturn is the cure. When you're all stuffed up and you're kind of sick for whatever reason, you're toxic, or you drank too much, or you ate too much steak or whatever, your body gets rid of that. It's uncomfortable, but as soon as it gets rid of it, oh, you feel better. So that's how you come out of it. The economy will heal itself as long as these central bankers either get out of the way, which again, we've agreed they will not do, or get their ass kicked so bad they don't get off the mat. They don't have any credibility. Next time, imagine this, after all of these iterations of greater money printing, and after money printing was really brought all together only in the depths of the late 2008, early 2009 crash, the deepest recession since the Great Depression, okay? And people see it worse than ever. Who cannot wake up and get that, Who cannot get, and then they come out and say, oh, well, and here's what they'll say, Janet Yellen, well, we didn't print enough, Tweety, okay? We didn't print enough. Oh, you mean 25 trillion and then, now another 8 trillion globally in the last year wasn't enough? Oh, what's it going to take now? 100 trillion. Okay, where does a crazy person in the streets just say, I'm sorry, I get this now? You have to go to extremes to prove something. That's what I see happening. It's going to be so obvious that these central banks are going to come back. But that is the debate between me and Rickards, which is interesting. And I still think there is a chance of his side. He's saying now, the first gold bug to admit this. I've been debating them for years, Schiff and everybody, okay? They're saying, no, money printing and we just inflation, and then inflation goes hyper, okay? I'm like, no, my story, impossible to create high inflation, nevertheless, hyperinflation in a deflationary winter season burdened by massive financial and debt bubbles. It's impossible to create it because you can't create the spending to create the inflation, as they learned early on, okay? So the other scenario, Rickard scenarios, we have a deflationary bout, but like 2008, it doesn't last that long, year and a half, and then they print 10 times what they did before. And then he'd say you would get substantial or high or hyperinflation. I am going to stand here saying, knowing that I could be wrong about this, but looking at human nature and history, they will not have the credibility to do it this time. And if they do, it'll just keep blowing up in their faces. But how many times do you have to do something? What do they say? Insanity is doing the same thing over and over and expecting a different result. How many times do you do something like this to now such extremes? They've already printed more in 80 months than in 8 years before, okay? What if they print 10 times that in the next year or two after deflation sets in? What does that look like to people? And does anybody even let them do it? Do even Democrats come out and say, we've had enough?
I guess you have I'm not sure if that will, if that part, it just, maybe, if it gets bad enough, it wakes people up, but it seems like, so many people just don't understand what's happening. But as you said, maybe it's so in your face that there's a shift and an awakening. But let me ask you, and that's that's the interesting conversation, right? There's a lot of, I would say, gold bugs that think, I think we're going to have another, big, gnarly, crash, but then we're going to head into, further devaluation of currencies and inflations and such like that.
Wait, which currencies? I'm going to ask them, which currency is going to devalue? We have a currency devaluation. I'm telling you where it's coming. It's coming in China, Europe, and Japan. It's not coming in the United States. 2008, only when, and this is when gold went down and when the US dollar went up, when they realized it was a serious crisis and there was going to be deflationary, the US dollar and the treasury bonds did well, and the gold and silver, and if we had had Bitcoin then, did poorly. That's reality. This has already happened in the first depressionary recession, and now we're coming in for a bigger one. So all I'm doing is saying, just look at what happened last time, make it more. Bigger crash, higher unemployment, dollar goes higher, gold and silver goes lower. What happens then? When people see that gold and silver, you know how many people have been told that gold and silver is the one thing that'll save your ass no matter what, and that doesn't happen? Do you think that would wake you up, Jake? I think that would wake anybody up. Wait a minute, I was told X, and at least these people were realistic, and then Y happened and X didn't happen. Gold was supposed to save me. Oh, and the dollar was supposed to crash because it's the horrible reserve currency. And the dollar went up and gold went down. That already happened in 2008 until they pulled on the monetary. So again, that's where I would say I could give Rickard's scenario some credibility after a deflationary surge. So first of all, I don't care if I'm right or wrong longer term right now. If this bubble crashes, I'm going to be out of stocks or short stocks, and I'm going to be in treasury bonds. And if it's just 2008 bigger, whether it lasts for a year or 3 years, I'm going to do well. Okay. I don't care whether it lasts 2 or 3 years yet. I can monitor it along the way. I'm already saying the next crash, if we follow suit, should be 47% down to 2,100 in the S&P within a matter of months. If that happens, I've already made a lot of money. I can pull back and reassess. Okay. That's the way I'm going to play it. I have what I think is going to happen, but I'm going to change that as I go along, seeing what do they do? How much money do they print? Does the public start questioning that for the first time? I want to see that. If they say we're going to print 10 trillion and the public doesn't question at all, then I'm like, well, okay, I got to back off here for a while and see how big we bounce. That's the way I'm going to play it. But you got to at least know reality and know that I hate to say it, wimpy academic like Janet Yellen or Jerome Powell can fight the bubble they've created. They've created the avalanche of all times ready to come down on. They have no chance of beating this when that avalanche, that final thing hits that just causes the switch to flick. I can't predict that. I think there's a good chance we're right there. But I can't predict that. But I can keep knowing what comes next and keep adapting and at least be on the right side of it. If you're expecting inflation to come out of this, you're already on the wrong side of it and have already been for years.
So then what do you think, or then let me ask you, so in a situation like that, are you then a buyer of gold and silver and stocks, or are you staying away because you think it's prolonged, or how are you playing that? I know you've written on in one of your books about sale of a lifetime. So are you a buyer of gold and silver there? Okay.
Yes, but for a different reason. Sale of a lifetime is a key thing. Almost all financial assets go down except for those safe bonds. Okay. That's the picture. And that's what happened in 29 to 32. I would be buying gold and silver, particularly gold, at the bottom of this crash to play the next boom. Where's the next boom? What did I say earlier? The next boom is in Asia. You know who buys the most gold compared to their income in the world? Indians. Indians. They love gold. Chinese, Asians love gold. There's a 30-year commodity cycle, one of the most reliable. It peaked in 2008 for most commodities, peaked in 2011 for silver and gold, late because of the monetary factor, the stimulus. Still went down, still low down. There's a 30-year commodity cycle driven by Asia where they love gold. I would be buying gold, not because it's an inflation hedge, because there's not going to be high inflation in the next boom, because the baby boom's over around the world and it's slower growth everywhere, even in high growth areas. I'd be buying gold because it's going to be a hot commodity for Asians. So I would buy gold when it's at 1,000 a few years from now, looking up to go 4,000 to 5,000. When I'm debating gold bugs, they say, well, gold's going to go to 4,000 or 5,000. I say, yeah, when you're dead. That's my answer. Yes, it will. When you're dead in the next 30-year commodity bubble, driven by Asia, the most gold-friendly people on earth from history. That's why I'd buy gold and silver. They're going to be undervalued, like everything, like copper, like stocks, like real estate. I'll tell you what I'm not going to buy, Jake. I'm not going to buy real estate. Real estate will never be the same. It's some chapter I wrote a long time ago, because the dying of the baby boomers is going to happen for more decades, offsetting the buying of the millennials. That's never happened before. Always been a bigger generation. You got a medium-sized generation following a large generation. The baby boom is going to weigh on real estate values in developed countries. If I'm going to buy real estate, I'd buy in India, and I'd probably buy infrastructures like parking lots. So I would buy for stocks in Southeast Asia and India and Australia. US, I'd buy aging industries. I'd be piling up on nursing homes and pharmaceuticals and late stage things. I'd be buying gold and silver, because all commodities are going to come back up with the next growth phase in Asia, and Asians love particularly gold. And I would no longer be buying the bonds that I'm telling people to buy, because we're going to see a slow rise in inflation for decades, and bonds don't like rising inflation, they like falling inflation. And we've seen falling inflation since 1980. So the bonds go out, and the stocks and real estate and gold and commodities come back in. I'm buying them all because there's going to be another financial asset bubble boom. It won't be as bubbly after we've wrenched this one out, and gold will be a part of that. And gold miners will be a part of that.
So let me ask you, right? So I'm with you, commodities, metals, you shared. So let me ask you, people listen to you and they say, Harry is so doom and gloom, he makes me feel, depressed. But one thing that you're saying is you do think there is a positive other side out of this that comes out, and you think that there's a.
Let me stop you there. This is BS. I was the single most bullish person in the world in the early to mid 80s, when everybody thought the US and Europe were dead and Japan was going to take over the world. Okay. I was the guy saying the one book after another, the great boom ahead, the roaring 20s. I am not a bearish person, but anybody that watches, let me tell you the difference between smart money and dumb money. You know how the dumb money thinks? The longer something goes up, the more you can bet on it and trust it. Well, maybe some things, but not financial assets. The longer they go up, the more they get overextended, overvalued. The smart money sees something's gone up longer and higher as more risky. The dumb money sees it as less risky. So anybody that's not at least thinking bearish with these valuations and these sort of bubbles one after the next and this much stimulus, you're the ones that are not in reality and have no common sense, nevertheless, any technical sense. This is a slam dunk. When it's going to happen is not. It's a slam dunk that these markets are most overvalued by every measure in history and will have to come down to reality, because all natural cycles boom and bust, inflation and deflation. You know what economists want? Economists want a machine. You know what a machine is? A suck economy like Japan has today. Machines are not organic, biological type of entities that grow dynamically. They're just machines. They just do one thing. They want to turn this into a machine. That's how you kill economy, and that's what Japan's done. They've killed their economy, and it would have been dead anyway because of their demographics, but they killed it on top of that. We need to reinvigorate our economy, clear out the brush, so the next time we have a crisis, we don't have another bonfire, okay? That's what we need to do. Clear out the brush, and then whatever we have in our favor, like blockchain technologies, which are Internet 2.0, people have, these are one-year-olds right now, Jake. This is a new industry that's following the dot-coms almost perfectly. And guess what the dot-coms did at this stage of the blockchain advance? Crashed 94, 95%, and then boomed like gangbusters for 15 years to follow. That's what I'm predicting. I'm bullish on Bitcoin and blockchain. but we're not in a phase you should be bullish. And I'm very bearish on a bubble that's so pumped up and outworn that should have peaked in 2007 and has grown bigger in difficult times. That's a slam dunk to be bearish on that. I'd be an idiot and should quit my profession if I wasn't bearish looking at that. I am not a bearish person. Most of my career, I've been more bullish than everybody. I'm more bearish now because I was more bullish and understand why we grew, why we overgrew, and why we can't sustain this. Anybody that you can't understand why we're going to keep growing if you never understood why we grew. I was the only guy that saw why we were going to grow. Baby boomers, young and unproductive and inflationary, entering the workforce, becoming highly productive on a predictable 46, 47-year lag, the simplest, easiest slam dunk indicator ever, and it worked. Because productivity and spending and kids and motivate, all this stuff comes with it, but one simple indicator will measure that. That indicator has been negative since early 2008 and does not turn up till 2023-24 in North America. Never turns up again, ever, in China or Japan and most of Europe. That indicator is the truth. How would you know it's the truth? How would you see the slowdown if you didn't see the boom? You have to understand both. They're both flip sides of the same coin. Boom, bust, inflation, deflation. And guess where, just to kind of give a little summary here, guess where the greatest, just guess on these cycles, inflation, deflation, boom, bust, where do the greatest innovations in history always occur? The greatest, deepest. Jet engines, automobile engines, electricity, you go on and on and on. The breakthrough, internet, where do they occur? In the most deflationary downturns and secondary in the most inflationary downturns. They never occur in upturns. When we're challenged, we have to adapt and we have to think differently, and COVID has already started that. This crash will finish it. We will see major innovations. We will clear out the underbrush and all these zombie companies and all this stupid debt, totally unproductive. People having to borrow money to keep the debt going. Does that sound productive? People borrowing money to buy stocks overvalued and real estate overvalued. People aren't just buying one house, they're buying a second house and then a third one to rent out. This is unproductive. This is stretching people. We got to get out of this and back into a real economy. And we can't do that until the bubble crashes and we're all into reality. And yes, everybody won't get it right away, but the smart people will. And that's called the S curve. Any new innovation will be followed by more and more people.
So what are the most important philosophies that you think are for the future, right? You've discussed your views on the economy, on the markets, on the future, and somebody says, hey, Harry, I understand that. Now, it sounds like there may be some, difficult times before we, get to the next level of human innovation and whatnot. What are important philosophies, whether they're life philosophies, mind philosophies, business philosophies, finance philosophies? What are important ones, do you think, for a viewer?
Well, again, two founding principles of my research. Everything grows exponentially long term. Everything. People think only exponential bubble, only when new technology. No. All of history, all the way back to the Big Bang, is exponential. But at the same time, all growth is cyclical. You have to grow and ebb. How are we awake all day? Okay, here's an exercise everybody on your audience can try. Try staying awake for the next 5 days and see if you lose your spouse, your friends, and have any sanity left. We are awake for 16 hours a day and we sleep for, let's say, 7 or 8. The sleep allows us to recoup, rebalance, clean out. That's what a recession is. You have to have booms and bust. Everything is also cyclical. Everything runs in cycles from 100,000-year ice ages down to your 1 second heartbeat. Boom, 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 boom. What is it? Out, in. It's not out, 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 out. You blow yourself up, right? It's out, in. Booms, bust. Inflation, disinflation, deflation, modest inflation, inflation. Contrarian wave is the first cycle I learned in college. I'm like, thank God there's somebody that's proven cycles, and they're always Russians for some damn reason. Contrarian, Always these damn Russians that figure out cycles. I think because life's so miserable there and they're more in reality. I don't know what the reason is, but you have to understand how and why things grow. We do not grow unless we're challenged. So challenge and nurturing, male and female, are two absolute opposites that have to happen for there to be growth. We can't even have kids without male and female, for one thing. But what you have to have is play of opposites to challenge and then nurture. You challenge, you innovate, and then the nurturing allows it expands mainstream. And when that gets mature and starts to fail, you got to innovate again because things are falling apart. And then that innovation gets into the next nurturing growth cycle. This is how growth actually works. The biggest problem I have with economists and with people, and I'll put it very simply, you know what people want? You know what every marketer has to deliver to get anybody to even listen to them? A zip line to heaven. That's what people want. That's what economists want. An economy that grows at 3 to 4% a year with 1 to 2% inflation and never has a recession. Wake up. Never going to happen. If you do, you kill it. You kill the dynamics that created the greatest explosion in wealth and income in history since the Industrial Revolution met Harry, free market capitalism, and Sally, democracy. Okay? Two opposites. Okay? Electrification and energy meets the greatest play of opposites, democracy and free market capitalism. Most of the people I grew up in South Carolina, they were the same thing. Freedom and, freedom and capitalism. No, they're not. They're opposites. Capitalism rewards the people who contribute the most and innovate. Democracy gives everybody a vote to include everybody and get everybody on the train. They have to work together. So it's the play of opposites. Everybody wants something else. Everybody wants a zip line to heaven. I don't want my kid to ever, try never letting your kid get in trouble or ever have any challenges or spoil them to death, and they will become the biggest fear that when I used to lecture mostly to wealthy people in the 90s for mutual funds, the biggest fear of wealthy people is that their kids will turn out to be Kennedys. The biggest single fear they have. That happens if you spoil them. We have a spoiled economy. Everybody expects more. We can't have a recession. We can't slow down. We can't let the stock market go down more than 10%. Well, wake up. You're getting ready to get your ass kicked when you're in that position. Booms, good times make people complacent. Difficult times challenge people, and that's where the innovation comes. Now, we don't want to be unhappy and challenged all the time and struggling all the time, so it only comes now and then, but that's the basis. You don't get the downturn, you don't get the challenge, you keep spoiling yourself, you don't let the economy go in a recession, clean out the brush and the bad debt and the bad companies and all the crap and stupid attitudes, like you can grow forever and something for nothing, then you end up dying. You kill the dynamics. Free market capitalism and democracy is the most powerful dynamic in history. The agricultural revolution was nothing compared to the industrial revolution with free market capitalism and democracy. What does blockchain do? Another bottoms-up software technology that makes it just more bottoms-up, more efficient, more fast, more secure, all these things. The internet has been great for transmitting information. It's not great for financial assets. I get hacked every 3 to 4 months and have to change my damn credit card still, okay? Because there's not security. Financial assets require something that information doesn't. And that's what blockchain's about. And it's in its infancy. And anybody that's ever gone through, and I consulted to probably 50 entrepreneurial companies and have started my own company. You do nothing but fail in the early stages. Failure is the game until you get it right. You fail, get up, get better. Fail, learn, get better. That's how you learn. Failure is as essential to the free market system as is as is success. People think, no, it's all about success. No. You have to have success and failure, like booms and busts, inflation and deflation, male and female, and on and on and on. That's the secret to life. It doesn't happen any other way. And so if you're going to understand anything, if you don't start there, you're just going to end up on let's figure out a theory that says we can have a zip line to heaven. And that's where we are now. Central bankers figured out how to have a zip line to heaven, and it's worked for 12 years, and it's going to not work very soon. and it's going to look like the stupidest, most naive thing done in history. You mean you really thought we could create sustainable, long-term, durable prosperity by just printing money out of thin air and pouring it into financial assets? You really thought that? And you got a PhD or a master's degree? You really, really, really thought that? Really? No. People didn't really think that. Somebody starts doing it, becomes popular, it seems to work. The longer something goes, right, the more people get onto it, okay? The longer it goes, the more it's about to change and have to innovate again to grow again, because nothing grows forever, because there's always cycles. So that's what it takes to understand. And I can't even argue with most people, because I'm starting with somebody that just thinks, well, why wouldn't there just be a zip line to heaven? I'm like, well, that's why we spend so much money on dumbass commercials to convince you to buy a product that has nothing to do with anything. We waste tons of money on marketing and advertising, and people buy tons of dumbass products because they're telling them they're going to get a zip line to heaven and they just can't resist it. So grow up. My problem is I can't find any grown-ups to argue with. I mean, seriously. If you think there's a zip line to heaven, then to me, I'm wasting my time to even talk to somebody.
Fair enough, Harry. Well, it was a pleasure to have you on. We went for about an hour, so we'll have a full episode for viewers. Leave a comment down below with your questions, things that I missed that you'd love to ask Harry. We'll have Harry back again on to answer some of your questions. You can leave them down below in the comments. Be sure to hit the like button on the right side, right over there, the left side. Send this message out to more and more people. As I know, Harry's...
Real quick, remember, harrydent.com, free weekly newsletter. You'll learn a lot for nothing, but you're going to learn more if you get on a real newsletter.
So right there down below, we'll have the link to that and the link to Harry's Twitter as well. And we thank you for coming on, Harry.